Good evening, everyone. Before we get going, I'd like to introduce Dr. Michael Green, who's our IR consultant here in London, and his associate, Alex Walters of Carrigan BR, and our Rod Venables of our new Nomad co-broker, who certainly can answer any questions if you can't trap me for something. Our presentation, most of the information on the company is on the website, so this presentation is going to be highlighting 3 of the major projects and what some of the key components as to who we are. And then any questions related to anything else, either we can answer or we can go to the website. Going to this slide principally because it gives us an idea of, pretty well who we are. We're on AIM. We have about 350 million shares outstanding. Management owns actually somewhere between 10 and 13, 14%, depending on how you compute fully diluted versus issued and outstanding, which means we have a significant float. And the year to date, you can see we're currently trading at about close to 3, and it's been as high as 9.75 and as low as 1.6. We have a market cap today of about 10 million pounds. We have debt of about 4 million pounds. That debt is fairly small in consideration to our assets. All the covenants are well maintained, and it's good for another year or two. And the point of taking the debt down that we have this year is to give ourselves some powder so that if we see acquisitions and mergers, we can use that if we need to. The interest rate is about 3.5%, and there's no fancy thing. It's just senior supported debt to our California assets. 3 months average volume is about 3 months. The daily average volume over the last 3 months is about 3 million shares. If you've followed us in the last few days, it's been significantly more than that. So some interesting things going on. Currently producing about 135 barrels a day, which should go to about another 100 barrels a day by the end of the year. With the drilling we're doing, we have 27 well bores in Tapia, which is our main asset in California. And that field has proved reserves of about 3.8 million barrels, with a net present day value of 10% at about 80 some odd million pounds. We have a significant acreage position. We basically work in California and Kansas, and our fiscal year end is December the 31st. We are profitable, and we have significant development going on. This is our financial data, which it's hard to read sometimes the numbers, so in the histogram format, basically this is a 7-year review of our financials. We've been cash flow positive for the last 5 years and profitable the last couple. Our lifting costs, as we develop principal field in Tapia, has come down from $35 a barrel down to $15. You'll see what that means in a short while. Our strategy for this company has been basically to look at acquiring long life. All our fields have an excess of 40-year life to them. And so we don't have to worry about pricing on a short-term basis, although it is significant, but we don't worry about it. We're partially developed, so we're not wildcatting at this point in time, and we control, we like controlling interest so we can develop it on our pace. By the way, we have no partners, and we have 100% of everything we own. We use our capital to create the value, at which point we will then either farm out, joint venture, sell, or at the appropriate time to get a good return on our investment. We develop these with our own funds. We operate everything, and we have a high working interest, 100%, as I said. In the case of California, we have a 90% revenue interest. In other words, we get 90% of the revenue out of 100% of the production runs. As I said, we will use our own capital to develop them, at which point we will then leverage them into something else through joint venture partners, sale, or other ways of capturing more value from them. And that's how we'll hopefully increase the value for the shareholders. Ventura Basin in in California. It's a small basin that's the majors got out and left a lot of undeveloped oil and gas over the years, in which we're in doing a lot of work. And Kansas is an interesting area. It's everything we do is fairly shallow and accessible to markets. And as you'll see, we have found an interesting little area that has access to the national market between San Francisco and Chicago in terms of gas, and oil, of course, can go anywhere. In California, Sefton has this Tapia field, and we have the Eureka field. Occidental, through its subsidiary Vintage, has the next field to us, that if you've read about it, they've started drilling as well. Our prototype out here is Berry Petroleum owns a field called Placerita, which is a full steam flood, and that's the prototype for us. And there's a lot of other areas out here that we could get involved in that haven't been steamed, which is the way, as we'll talk about in a few minutes, to get the thing out, the oil out in a lot more oil than in essence has been left behind, and our forte is to go in and try to find that and capture it. Heavy oil is historically has had a kind of a bad reputation. It's usually traded at a discount to NYMEX. Right now, today, we are getting 20% above NYMEX. So current price is $88. We're getting in the vicinity of $100 still for our oil. It's almost Brent prices, which is, for 17 to gravity oil is amazing. In that part of California, the refineries need it to blend with the other oil that they're geared to process. So we're doing very well in terms of the current price, and that will be reflected in a short while. This is the way we've modeled it. We've drilled 15 wells. There were certain wells there already, and we have about 7 more wells to drill. The metrics on this are we own 100% and the revenue interest is 90%. It costs about $600,000 to drill about 2,000 feet. The API of the gravity is 17 to 19. You might have heard of Kern River, the real heavy oil stuff. That's about 13 gravity, so we're significantly higher than that. And of course the tar sands is in the 6, 7, or 8 region. So we're certainly a lot more fines in the oil. At $95 a barrel, which has been averaging what we've got, operating costs are $15 a barrel. Production taxes about 6%, $5.50. Royalty is $9.50. The entire corporation's G&A is about $25 a barrel at 150 barrels a day. And so we net $40 per barrel. So the more we produce, the more we net. And in other words, the other way of looking at that is oil could go down to about $40 a barrel and we'd be surviving. And all our reserves that you'll read about or have read about are based on a 50% recovery of the oil in place. There's about 11 million barrels of oil in place on this field. And normally primary drilling will get 10, 15% out of the ground, and there's various processes such as cyclic steaming that we'll talk about that you can get an extra. And if you can get into full steam flood with these fields, you can get as much as 70% out of the ground, which is significant. But all our numbers that you'll see are based on 50%, and based on what we're doing, you'll see that we have tremendous scope to improve those without improving our reserves without taking on any other projects. And the end of last year and 6/30 of this year, we have a third-party engineer because of the bank put together a production forecast. In other words, what's the production been and where is it going based on the data that he has. This field, this is a log scale, and I'll get to an easier explainable slide in a short minute. The field when it was drilled by Tenneco, Texaco, and others, that was its production. This is when we picked it up. That it is today, and that's where we hope to go in the future. And a more easily explainable thing, it was about 130 barrels a day. This is just taking that graph and putting it in barrels per day numbers. Maximum is 130 today. We quieted doing about 26 average. It's now 150, and at 800 is where the engineer believes it can go based on 50% recovery of the oil in place. What steam flooding is to take this asset is that heavy oil, if you can heat the reservoir, you improve the viscosity and you can get more oil out of the ground. And the way to deliver heat to the reservoir, the most effective way in this area is through steam. And you can do that through many ways, which I'll talk about in a minute. And we've been doing that. We have 2 pilot programs of cyclic steam, where you shut a well down and inject steam to heat it up, and then you put it back on. And another pilot we've had is where you inject steam into a well that's not being used that much, and so the steam goes in, so no wells have to be shut down, and you can monitor the increase in production from that I'll talk about. And after doing that, we've engaged probably one of the foremost authorities on heavy oil, Dr. Farouq Ali out of Alberta. He's a professor up there, and he's also worked in the tar sands and pretty well all over the world and for all of the majors. And we found about him through a field close to us in California. We talked to him, and he's taken this project on. And everybody, of course, is going to ask me, when is this report coming out? And we'll talk about that in a short while. It's on its way, but like anything else. But In essence, what we're doing, we talked about, well, we drilled out the field and we've been producing it right now on primary. We then went in on, we drilled 15 wells in the last while, and we've gone in on every one of those wells and we've shut the well down, we've injected various amounts of steam. Again, it was a pilot, so we're trying different things in that well, let it circulate for a while and heat up the reservoir, and then we put the production equipment back on and we pump it out. And invariably we got an increase in production, some better than others, and we experimented with more steam and more soak time and things of this nature, and all of this has been fed to Dr. Ali. Cyclic steaming will give you an increase in production, and it tapers off back to its production profile after usually anywhere from 3, 5, 6, 7 months, depending on how much steam and for how long you put it in. We did that primarily to see whether it would work, which it did, which should give our engineer and Dr. Farouq Ali the time to determine what sort of recoveries above 50% we might be able to get. The next step, which we're just concluding, was a continuous steam where we took an old well that wasn't producing, and we injected steam continuously in that. By the way, we bought our own steam generator, and we have gas running through our field, and we have free water, so it's easy to, it's very cost effective for us to do this. And we inject it in on a continuous basis, and then we start monitoring the wells around to see the effect as the steam, both the pressure and the heat expands through the reservoir. And eventually we hope to put a steam flood together, and what that would look like is the red areas would be where we'd inject the steam and the oil would be collected in the green area, so there'd be no production shut down. And then that would be a continuous operation, so the reservoir continues, heats up and gets hotter and hotter and basically releases more oil. This comes from the geologic model we performed or put together from this Canadian group that leads into Farouq Ali's simulations, thermal simulation study. And this is a map that shows the net pay from all of their modeling, the net pay above 10%, in other words, what they believe the oil, the amount where the oil is and that's left in the field as you look across it. And we have and as I say, this study ended up providing us with about 500,000 grid units that go into Dr. Ali's study, which is about almost about 3 times what we expected. Therefore, the length of time and the cost, of course, to complete this study. Running a cross-section through that along the axis of the field shows where the oil column and the water column is. We are in the process of getting a rig to move in the next few weeks, and we will be drilling before the end of the year these 4 wells. Again with primary, and we'll core them, which we normally wouldn't do. That information will be fed into the the end of the year to upgrade Dr. Ali's report, but although the bulk of the work will be done here in a short while. That's one of the fields that we have in California. We have 2. In Kansas, we were looking for a diversification of geography and commodity, and we got involved in originally gas, it's actually oil and gas, in 2 areas that have a unique system where the risk is low and the access to market is good. And we basically have pipeline infrastructure revenue. In other words, we can transport other people's gas in an area where it hasn't been producing gas for a while, and we can transport our own gas. So we have 2 sources of revenue here, and we have a couple of projects, and I'll focus on one of them, which kind of outlines what we're doing. This particular map shows this area. The major interstate pipeline here, right there, the major pipeline between Chicago and San Francisco runs right by us. And the blue line is an access to that through a major company called Southern Star Pipeline. And what we have done is right in the middle of our field up there, we have access to that, and we have the access. And what we've been negotiating recently is improving the access equipment and the transportation agreement. How much can we put in and for how long and on what basis? And we're right in the middle of those things now. We've agreed to the upgrade of the facilities there. Not much, we're talking about a couple of $100,000. And now it's a question of how much gas, and it'll be between maybe 500,000 cubic feet a day and 11 million cubic feet a day, which for us is a significant amount of gas. But what we have done in that area when the price of gas was down is we discovered that this area has not been active for about 15 years because all of the pipelines really were not transporting gas into the system. So we went in and we bought all the pipelines that we could up in that area. And they were costing us very little, about $150,000 a piece, and it's cost us about another $100,000 to $200,000 to test, fix, and get them certified. We will be certifying 2 pieces here within the next week or so, and the other one, so we've got 2 of them, and we'll be joining them either later this year or early in next year. But the key is, with our negotiations with Southern Star into the major interstate pipeline system, they have gas storage here that we have the ability to put gas in at a low revenue time of the year and take it out in the winter and it's high revenue. We literally control about a 200 square mile area here. So if you have any gas in that area, you're going to have to come to us to get it into the major pipeline system. And what's interesting enough, a lot of the oil is limited in its production because of the associated gas with that oil. So to improve their oil production, they're going to have to get rid of the gas. You can't flare it, so they're going to have to come to us as well. And a lot of the acreage is open here for prospects that we can generate. So we have an interesting situation here where we have third-party revenue plus through the pipeline system and revenue from our own oil and gas. And of course, as oil and gas developers, we will have the revenue from that. This just shows some of the pictures, and we also have another project. We have a pipeline in the vicinity of another major pipeline 60 miles away. Again, we have a couple of projects in each of these areas, but I'll just focus on one of them. As far as the export, that was the pipeline side of things and getting the gas to market. This is showing basically what our exploration and production is going to do. We basically we have a significant acreage position, about 10,000 acres, and we have a lot in which we can acquire because there's been no activity in the area. So the question is, what additional acreage do you look to obtain? What you find here is there's an erosional surface, Mississippian time. This is at about 2,000 feet, and structurally it's dipping to the west, and this signature has been imposed on this surface from the time it was developed, and it's been folded, and we have found a method of we haven't found it, but we have a method of restoring that surface to the way it was at Mississippian time, so we could see how that drainage pattern would fit as to where the production is, and what we come up with is a map restoring it to the time in which it was deposited. The blue areas are the valleys, lows, and the warm colors are where the highs are. The significance here is that you'll find the oil channel sands in and along the lows, and then these gas deposits will be related to these high remnants and or point bar sands. That's significant for us because if we have any priorities, our priorities here will be going to acquire the oil leases and develop them first. Of course, there's gas associated with it, and our gas will be second priority because of the price of gas. So our priority will be getting the pipeline running and moving other people's gas through initially. Then we'll look at acquiring more land above what we have that has oil potential on it. We already have some of that ourselves. And then the third priority will be our own gas from that. Basically, if you look at the reserves, I'll give you a much fancier one to look at. We have proved reserves, as you heard, of about 3.8 million barrels. That consists of proved, developed, producing, proved, developed, non-producing, and proved undeveloped, which means you have to drill it to get to it. And we have some probable. And then we have resources, which is mainly Kansas. The minute we get that contract with Southern Star executed and we certify our lines, we will move some of this reserves into the proved category because we have wells on these leases. They just haven't produced for a while. And then as we start to generate revenue, that will generate cash flow. Our goal by the end of the year is to improve the revenue. We're drilling wells at Tapia. We'll increase the reserves at Tapia based on the Farouq report, or we expect it to. And we'll improve reserves in Kansas by virtue of completing the access to the pipeline, which then the engineers will allow as reserves because they can get to market. Goals for the year. Cash flow, obviously, from the drilling and developing existing assets. We're strengthening the balance sheet, improving the reserves and the revenue. We plan to expand the board with a few more non-execs, widen the shareholder base, which is why you haven't heard from us in the last few years, but this year you've heard a lot from us and you'll hear a lot more. We've engaged an IR team to work with us and to get our story out so we can get some value for the shareholders. And next year, because an obvious question is how we're going to finance some of these things, particularly the development of the steam flood. We have many options. We have debt, we have cash flow, equity, and joint venture partners, which might be the most obvious way. Undervalued, as is everybody you'll see. Everybody claims to it. We have gas interest that will give us upside in value. We have a nice prudent mix of oil and gas because, you know, gas will come back and have great value. If any of you read the FT about Kinder Peabody, you can see people are looking long term, and they are definitely seeing where the price of gas is expected to recover. It does fluctuate back and forth. Improved oil recovery by the steaming process. And we have substantial growth, again, just within our own asset base without going outside. And there's always opportunities to aggregate more within the areas that we're working in. They have independently a net present day value, which is significant. Of course, you can't sell it for that, but it's a marker. But you can certainly, we could dispose of these assets at a way higher value than the market cap. And as our nomad was not too happy about this last statement, I'll tell you we basically are unashamedly getting this message out by appearing in front of you. He just is shaking his head. He doesn't like statements like that, but we overruled him in this instance. That's in a nutshell is the three main components. Oil in that one field, Tapia. We have other oil fields and other leases in California. Gas, transportation system, and gas and oil revenue from our own exploration in Kansas, those two in Kansas. That's the summary, and as I say, we have approximately $3 million in the bank to fund pretty well ourselves through these next drilling. Last month alone, just on the existing production and the price, we pulled in $427,000. So we're getting pretty good revenue, and as we drill 4 more wells, which we have the money for, we can expect that to pretty well almost double. And so we're in pretty good shape. Yes, there's huge financial expenditures over the future years, and we're really waiting through the end of this year to see Dr. Farouq's report and certification of our lines and contracts with a major pipeline system. At that point, we'll take a look at what's available to us. As I said, debt, equity, cash flow, joint venture financing. Occidental is drilling next to us. We'll know in the next, in California, in the next field, less than a mile from us. We'll know. They have to report it to the state of California, and I know some of our shareholders love to go into the California files and find out what we produce before we announce it, but that will be available shortly, so we'll be interested in seeing what they're doing, and that obviously opens up the potential of I don't think we'll see 2 gas power plants to develop the steam. We might see 1, and what the relationship is with ourselves and Oxy will be interesting to see. Anyway, thank you, and certainly any questions you wish to ask, I or my friends here will be gladly answer them.
Any questions? Hands up for this gentleman.
Yes, excuse me. Why are you listed on the London exchanges as opposed to the USA, with your assets being in the USA?
The history is I've been involved in companies that have been public here since the 80s. We've had duly listed NASDAQ, USM. NASDAQ is no longer a market for startup companies. AIM is probably the better one in terms of if you want to run your company and have flexibility to run it. The type of investor is a lot different in the US, and it's just that AIM founders liked the political stability of the US. We like the AIM market because of the ability to run your company a lot more efficiently and cost effectively than in the US. And we have a BVI company with holding subsidiaries to hold the assets, and our intention was, and it still is, to eventually be international in our holdings as well as our listing. And America, quite candidly, even though I live there, it's a very provincial entity in terms of it's mainly just America, of companies of our size.
Okay. Next question, Mr. Gentleman again.
Yes, sir.
Regarding your gas distribution in Kansas, and as a small company in the area amongst all the big boys, how does that translate for you and become effective?
Our economics are done at $4 an MCF, and the price right now is not 5. The strip price is 5, so that's where it's going. Well, all our economics are done at 4, and we can make money at the $4 level. Not a huge amount, but we can make money. And these things have 25-plus year lives because there's both coal bed and conventional oil and gas associated with the oil. A year or so ago, when the price was down, we were wondering how we're going to develop this area, and that was when we realized that oil can be trucked to the market anywhere and any which way. Gas, you have to be able to get to the market, and we just saw an opportunity that in that area it was close to a major system, and it's really full of small little guys that have never really taken a look at the big picture. So we were able to go in and garnish the infrastructure and hopefully put it together, and we're already that we have 3 companies knocking on our door saying, how are we going to get our gas to market with you? And we can be pretty hard-nosed about it in terms of what, you know, as an example, you know, the oil people, we'll probably get their gas for nothing just so they can increase their oil production. And we could, and then the interesting thing that if you look at thinking long-term is, as the gas price recovers, in California for a steam flood, you are going to need a lot of gas to heat the water. Well, we have a gas source that we can trade off. So we can mitigate the cost increase of gas prices in California by using our relatively easy and inexpensive gas sources in Kansas, particularly if you have the infrastructure to get it into the pipeline system to do the swap. So these are all the components, and you know, it was one of those situations where, you know, you have to think 5, 10 years down the road. We'll be producing, you know, next year. We'll be getting reserves on the books this year, proved reserves on the books, and we'll be getting production from them next year. But the point is, the long-term benefit is phenomenal, because gas has a lot lower lifting costs once you've got and if you own the infrastructure, it's even lower. So we can probably make money better than most by owning the infrastructure rather than just being someone looking for a pipeline to put it into. Does that answer your question? Yeah. Right.
Any more questions? I saw your hand first.
How are you looking at separating your pipeline business from your oil and gas business?
We have formed a company called TEG Transmission, and all our pipeline, and if that's principally one of liability more than anything else. We're in America, remember. And so we have formed a company, and all our pipelines will be going into that, and it will be a separate resource. And from an accounting point of view, we report under IFRS, and we have basically 2 components, oil and gas exploration and transmission. So our transmission is in its own corporation, and it will be treated as a profit center just like each and every project is. The interesting thing is we could sell it to it at a low transportation charge and make money on the exploration side, but then we could sell it at a high price and make more money, make money on the other side. So that's an interesting dilemma that we'll have to deal with in the next while. Yeah.
You first, then you.
Yeah.
What happened in May regarding the leap in your share price?
Historically, we've been focusing on Tapia, our oil production, and we'd never, once we gained the infrastructure in Kansas, we had a greater likelihood of bringing the gas to market under the current pricing scenario. So we engaged for the first time an independent analysis of our holdings, you know, to look at the gas prices now and with the infrastructure, how we get it to market. And we were quite blown away by the results, as was everybody else. It was a report that showed that we had another $100 million of potential, $100 million of potential capability there. That's a long way from it, but it was the first time anyone had ever seen any value put. All of the research we'd had in the past is, well, we don't know what Kansas is, so we're not including Kansas in the analysis of Sefton. Well, now all of a sudden we had, you can say, well, let's give it a quarter or half of that value. All of a sudden it was transformational in terms of what the long-term value of our company could be, and that's what happened. Yep. And we really had no follow-up in terms of the market support, and so it shot up and it kind of dropped down. Well, we've made some moves, as you well know, our good fellows at Northland, who will certainly eliminate that from now on, right? Sorry, Rod, I couldn't resist it. Sorry. Yes, sir.
really liked your presentation. Rivington, what percentage did they in their client zone of your shares?
Very, very little. We had Rivington as a co-broker for a short period of time, and we did a placing with them, but that placing went principally to our existing shareholders. So really their influence, and that's one of the reasons why we've moved on, is because I could have contacted those shareholders. And
they're not your corporate broker anymore?
No, we have Northland is our co-broker and our Nomad, and we have Dowgate, who is the other co-broker. And we have a history with Dowgate from the very first IPO. Yeah. Well, thank you very much. I appreciate it.
Okay, well, thank you very much.